Hello, everyone. Welcome back to the Investment Diary. In the first week of February 2026, nearly $300 billion was wiped off the software sector. They're calling it the SaaS apocalypse. The narrative is simple. AI agents are here, they don't need lunch breaks. Everyone thinks AI agents are about to kill SaaS. The narrative is brutal. New models, specifically the latest Claude updates, are getting faster, cheaper, and more autonomous. The logic follows, if an AI agent can execute the workflow, why do you need the software license? Most investors are running for the exits, but I'm doing the opposite. I just opened a new position in ServiceNow. Not because the risks aren't real, they are, but because the market is pricing in a funeral for a company that just posted its best cash flow year in history. I didn't buy because the risk has disappeared. The risk is real. I bought because I believe the market is making a fundamental error. It is confusing tool replacement with platform displacement. Those are not the same thing. And today, I'm going to show you why the death of SaaS is actually the buying opportunity of the year. That is a seductive narrative, but it's the wrong framing. AI models don't run enterprises. Enterprises run on governance. They run on permissions, audit logs, compliance rails, state management, and security boundaries. An AI agent can think and code, but it still needs a system to act safely. It needs a place to log its work. It needs a place to be audited when it messes up. That place isn't the AI model itself. That place is the workflow control plane, and that is exactly where ServiceNow lives. Many investors still misclassify ServiceNow as just IT ticketing software. If that's your view, you are missing the entire thesis. That view is 10 years outdated. ServiceNow is the workflow operating system for the Global 2000. ServiceNow helps the enterprise to orchestrate the following key functions. 1. IT service management, keeping the lights on. 2. HR workflows, onboarding, payroll disputes. 3. Security operations, incident response. 4. Customer service, CSM. 5. Governance, risk, and compliance, GRC. If you tell me a large enterprise is going to overhaul all the above existing systems that ServiceNow has already built in for the companies, good luck. Here is the critical insight. AI needs rails. When an autonomous agent is told to onboard a new employee, it can't just hallucinate a laptop into existence. It needs to trigger a procurement flow, update the Active Directory, and provision security badges. ServiceNow builds those rails. And they aren't ignoring the threat. ServiceNow has partnered directly with Anthropic to integrate Claude into the Now platform. They are making Claude the engine inside their car. This tells you they aren't defending legacy software. They are upgrading the platform to be the AI control tower. Let's look at the moat analysis. Why can't a cheap AI wrapper replace them? 1. Switching costs. Replacing ServiceNow isn't like swapping Slack for Teams. It is deeply embedded in the plumbing of a company. To rip it out, you would have to rewrite thousands of custom workflows, rewire integrations, retrain your entire workforce, and most importantly, revalidate your compliance audit trails. That is a massive, multi-year headache that no CIO wants. 2. The expansion flywheel, the numbers. Look at the Q4 2025 numbers. If the business was dying, demand would be drying up. Instead, we see the opposite. Subscription revenue, $3.47 billion, plus 21% year-over-year. Current remaining performance obligations, $12.85 billion, plus 25% year-over-year. Total RPO, $28.2 billion, plus 26.5% year-over-year. Pay attention to CRPO. That is the backlog of non-cancelable contracts for the next 12 months. When backlog growth, 25%, is higher than revenue growth, 21%, it means demand is accelerating, not collapsing. 3. Platform economics. This is not a growth at all costs burn pit. This is an elite cash compounder. For FY 2025, they generated $4.6 billion in free cash flow at a 35% margin. For FY 2026, they are guiding for 21% growth and 36% FCF margins. Rule of 40? They are effectively at the rule of 57. 4. Capital allocation. Finally, look at what the insiders are doing. The board authorized a new $5 billion share repurchase program. Barron's also reported CEO insider buying during this weakness. When the sector panics and the insiders start buying with both corporate cash and personal cash, I pay attention. Here is my framework for who survives the SaaSpocalypse. I categorize software into 3 buckets. Category C, thin feature apps. If your product just summarizes meetings or writes emails, you are dead. An AI model plus a light UI replaces you instantly. Category B, systems of record. Think ERPs, SAP, Oracle, or massive databases like Snowflake. Hard to replace, but slow to move. Category A, workflow control planes. This is where ServiceNow lives. They benefit from AI because agents need orchestration. If ServiceNow succeeds in becoming the manager of agents, AI will increase the usage density of their platform, not decrease it. This is the bet. If I'm wrong and they get commoditized into Category C, the stock goes much lower. But I view them as the ultimate Category A player. Okay, so now let's talk price, which is the real reason why I pulled the trigger. The stock recently traded down to the $105 range after the drawdown. Is that cheap? Let's run the DCF. I'm anchoring on about $4.6 billion in FCF and 20% growth. With the bear case, the assumptions are AI disruption is real, growth slows to mid-teens immediately, then single digits, margins compress to 32% as they lose pricing power, WACC at 10%. That brings a fair value of about $90 to $95. At $105, the market is pricing in a scenario very close to this bear case. Now, the base case. The assumptions are that growth fades gradually to low teens over 5 years. Margins expand slightly to 38%, software operating leverage. This gives us a fair value of about $145 to $155. This represents about 40% upside from the lows. Lastly, the bull case. Assuming the AI control tower thesis works out well for ServiceNow, AI attach rates drive sustained high teens growth. FCF margins hit 40%, elite scale. The fair value will be $180 plus. This is what asymmetric upside looks like. The market has priced the stock near the floor, bear case. If anything goes right, if the SaaSpocalypse is even slightly exaggerated, the stock re-rates to the base case rapidly. I am not married to this stock. I will sell it in a heartbeat if the data changes. Here is what would make me wrong. 1. CRPO to coupling. If backlog growth drops below revenue growth, it means the future pipeline is rotting. 2. Renewal rate decay. If retention drops below their historic 98 to 99% levels, it means customers are actually ripping them out. 3. Pricing power loss. If they have to discount heavily to keep seats, the margin story collapses. I am watching these metrics like a hawk, but as of Q4 2025, they are all flashing green. Look, the market is pricing AI as a SaaS extinction event. I think it is a redistribution of value. Value is shifting away from seats doing busy work and toward platforms that govern execution. ServiceNow is positioning itself to be the governor. That is why I bought, not because it is safe, but because the panic created a price where the odds are heavily in my favor. If you enjoyed this deep dive, do help me out and hit like and subscribe button, and I will be posting more videos every week on stock market updates. You don't want to miss that. Thanks for watching. See you in my next diary.